The free banking era in the United States occurred between 1838 to 1862 and is a good indication of the market's superiority to the Federal Reserve. During this period, state chartering requirements to open banks were eliminated and there was no central bank. The free banking era was a massive 2-decade economic expansion. Long-run inflation during this period was close to 0%. Overall, it was a successful period for both banking and the general economy. The free market allowed for competition, which resulted in higher quality, increased output, greater efficiency, and lower costs for consumers. However, this era was not a true free banking period because excessive government regulations existed that created significant problems. The main example of toxic regulation during the free banking era involves clearinghouses. One of the main issues with the free banking era was that bank failures and panics occurred very regularly by today's standards. During this period, clearinghouses operated as the lender of last resort, a role that the Fed has taken on today. Clearinghouses had rules for banks to be able to join them, such as reserve and capital requirements, as well as inspections by clearinghouses. In a free market, if clearinghouses wanted to remain profitable, they had to create these rules for banks to ensure solvency. Free enterprise successfully and innovatively manages risk. Due to government regulation, though, clearinghouses could not function properly. During the quote-unquote free banking era, anti-branching laws prevented banks from opening offices in new areas. This decreased competition. It also increased risk by preventing diversification and liquidity. Issuing banknotes was also heavily restricted and regulated by the government. This further added to liquidity and money supply problems. As a result, clearinghouses could not operate effectively as lenders of last resort. Bank depositors knew this and therefore knew that if a bank run occurred, banks would not be able to secure the proper funding to pay out all of their depositors. This caused bank runs and bank failures. The systemic problems of the free banking era were caused by over-regulation, not the lack of regulation. Canada did not have these regulations, and the amount of bank runs and panics it had in the late 1800s were trivial in comparison to the US during that same time. The marketplace was freer, and clearinghouses and other market participants could actually function properly without the unintended consequences of government regulation. All the roles that the Fed takes on today, transferring funds between banks, issuing currency, regulating banks, acting as a lender of last resort, and controlling monetary policy, are better handled by the marketplace. Clearinghouses can transfer funds between banks and act as a lender of last resort. Banks are regulated by competitive market pressures that ensure quality and proper risk management. Unhindered markets lead to increased quality, quantity, efficiency, and decreased costs for consumers. Private banks can issue competing currency that is created by profit incentives instead of government fiat. Market forces can set monetary policy such as, inter alia, interest rates based on supply and demand instead of central planning. Competition would create currency that doesn't routinely get devalued, unlike currency created by the Fed and its printing press. Opponents of a free market in banking suggest that the financial industry, and specifically banking, has special concerns surrounding it that warrant government intervention. Banks deal with high levels of risk, loan out money, and influence all aspects of the economy. However, it is because banking is so important that government should not be involved in it. The government cannot operate industries at a higher quality for lower costs than the free market. If it could, it would have to run these industries more efficiently than the marketplace, and there is not one example of the government being more efficient than the market.
In order for them to bring down the cost of healthcare, the government would have to operate the system more efficiently than the market does. I can't think of anything that the government operates more efficiently than the market does.
There are many other alternatives to the Fed that would be far better for the economy. Free banking is just one example, and it may not even be the best option, but it is a better option than the current Federal Reserve System. A true free banking era would allow for a more efficient use of resources by having competing banks with the proper incentives. Instead of the Fed trying to operate a command economy from the top down with political incentives, competing banks would have the proper profit incentives and knowledge to operate more efficiently and effectively from the bottom up.